In the year 2023, the world watched Credit Suisse get swallowed in days. But the real run didn't happen at an ATM. It happened inside hidden pipes. If you think your money is sitting in a vault, you're missing the danger. When these pipes leak, your mortgage and business loans feel it first. This video answers only one question, without any tips or recommendations. How can a regulated bank still face a run that overwhelms it in mere days? Most people picture crowds and cash withdrawals, like a movie from decades ago. Modern runs are mostly silent. Apps, wires, and risk systems flipping to no. In the year 2022, Credit Suisse saw Q4 deposit outflows hit CHF 138 billion. FINMA says its liquidity model implied about CHF 91 billion, and reality beat it. That gap is the story. Rules assume a speed, and digital life changes the speed. Let's begin with the most basic truth about banking. Banks rely on short-term borrowing to fund long-term lending, creating the foundation of their business model. Deposits feel stable, but they're withdrawable on demand under normal terms. Long assets are things you can't instantly sell without taking a price hit. That mismatch isn't some scandalous flaw. It's the fundamental driving force behind how commercial banks operate and make money. It works fine until confidence breaks, and the short side stops rolling over. Confidence here isn't vibes. It's other people keeping funding in place today. The obvious story is panic. Like depositors just get scared and flee. That's real, but incomplete, because bigger pipes move faster than retail. Large clients and wholesale funding can exit in minutes, not weeks. FINMA says outflows for some groups were higher than LCR assumptions. Some deposits are insured, others aren't, and big money tracks that closely. So the first missing piece is incentives. Who loses first if things go wrong? Now the second missing piece is the one most people never see: collateral. Collateral is the asset you post so others trust your promises right now. A repo is essentially a collateralized loan, where cash is exchanged today in return for securities that are pledged as a guarantee for repayment. In derivatives, trust is enforced through margin extra collateral when prices move. A margin call is a non-negotiable, automatic demand embedded in contracts, requiring immediate action, not something you can choose to ignore. Here's the mechanism. Outflows drain cash, while margin calls demand more cash. To raise cash, you sell assets, but stress sales can force losses. Mark-to-market means assets are valued at today's market price, not yesterday's. Now a fast what if to make this real. Imagine trying to sell your house to pay a bill due in 1 hour. Even if the house is worth millions, you're broke until a buyer appears. That is the liquidity trap. Value exists, but cash is unavailable when needed. Banks can be solvent on paper and still become unpayable short-term. FINMA noted Credit Suisse was solvent on a going concern basis, yet stressed. Because the crisis isn't only about assets. It's about timing and trust. And timing got brutal once digital withdrawals and headlines moved together. Information travels faster than balance sheets can be explained. Depositors don't audit footnotes in real time. They react to signals. Signals include ratings, spreads, headlines, and whether big players stay. Once a few large clients move, others infer risk and move too. This is why digitalization can compress a run from weeks into hours. Buffers were calibrated for older run dynamics, not smartphone speed. Now meet the rule people cite as the safety net, the LCR. The LCR, or Liquidity Coverage Ratio, is a key Basel rule crafted to ensure a bank can withstand a 30-day period of financial stress without running out of cash. It assumes high-quality liquid assets can cover net cash outflows in stress. But the key word is usable. Unencumbered means assets that aren't already pledged or tied up elsewhere. Because once an asset is pledged, it can no longer be used again as collateral. So a bank can have assets and still lack usable collateral for fresh cash. That's when the run stops being a line at a branch and becomes a lock. FINMA described counterparties demanding additional collateral at Credit Suisse. FINMA also described counterparties terminating activity, tightening the pipes. So the run moves sideways. Markets close doors even before deposits hit zero. Now connect it back to Credit Suisse in the year 2022. FINMA reports 51% of Credit Suisse term deposits were withdrawn in Q4. FINMA also notes major outflows in parts of the investment bank deposit base. Credit Suisse filings describe severe client outflows and funding stress in that period. So, what does a bank do when trust evaporates and contracts demand margin? It reaches for central bank liquidity, but central banks also require collateral. Support is structured lending against eligible assets, not magic cash. In the year 2023, Credit Suisse said it would borrow up to CHF 50 billion from SNB. And in the year 2023, SNB announced large liquidity assistance backstops. Notice what that means. Support exists, but constraints still apply. If your best collateral is already pledged, your flexibility shrinks fast. This is the nasty second-order effect. Survival actions can breed fragility. The more you pledge to survive today, the less room you have tomorrow. It's like pawning the spare tire to buy fuel, then hitting a nail at speed. That's why modern runs are mechanical, not just emotional. They are a collision of deposits, collateral demands, and information speed. When the incentive shifts from lend to protect, behavior flips instantly. Repo terms tighten, haircuts rise, and funding becomes more expensive. A haircut is a safety margin. For example, if collateral is worth $100, you can only borrow $80, with the $20 difference serving as protection against market fluctuations and loan remains secure. That protects lenders, but it drains borrowers' liquidity at the worst moment. Now the personal impact. Because this plumbing always reaches real life. When banks hoard liquidity, credit becomes scarcer and more conditional over time. Businesses feel it as tighter terms, slower approvals, and higher spreads. Households feel it through stricter lending standards and pricier borrowing. Even if you never owned a bank stock, your economy runs on these pipes. And regulators care, because if funding markets seize, healthy firms get trapped too. Another hidden amplifier is shared collateral moving across many contracts. When one link breaks, everyone wants their collateral back at the same time. That's why the system can look calm until it suddenly isn't. So the takeaway isn't banks are evil or depositors are irrational. The takeaway is incentives. Short funding plus fast exits creates run risk. Money here isn't stored safety. It's a network of contracts that needs trust. Is banking a network we should trust? Or plumbing getting too fast for itself? Tell me what you think in the comments, and drop questions we should answer. Next layer. What happens when the run starts in the funding market, not a bank? It's not just banks anymore. What happens when the plumbing itself breaks? A modern bank run doesn't stop at the bank, it spreads, because everyone is connected. In a few years, that speed could trigger a whole new kind of crash, and no one is ready. Think about this. What happens when the rules are too slow to catch up with the tech? How long will it take before someone else's plumbing breaks? And who will be next? Will we be prepared? Or are we just one shock away from another collapse? When the financial system operates at this breakneck speed, who truly holds the reins and what catastrophic consequences unfold when they lose control?